Okay, so my name is Brian Fitzgerald here with Keegan Crosby, and today we're here talking about our business, Better Technologies, what we've done in the past and what we plan on doing in the future. So on our first screen here, we do have our financial performance and what we've done over the past 9 years. Starting on the top left, we have our net revenues. As you can see, it's gone up at a pretty steady pace over these past 9 years. Next, we got earnings per share that have gone up pretty steadily, but it looks like we had a little bit of a hiccup between 11, 12, and 13. And that's a recurring theme you're going to see. And I'll go into more detail about what happened with that and explain that here. Next thing we have return on equity. It's a pretty steady incline. Looks like that 11, 12, 13 wasn't really affected by it. Credit rating, it's once again a pretty good incline. And then there's that dip right there. Stock price, it once again incline to a little bit of a dip. And the image rating, looks like it was a little bit affected by that dip in 11, 12, 13. So what we have for the business is our strategic vision. And what we'd like to do is have the best price performance in cameras and UAV drones. We'd love to expand the market for those products, and we'd like to stay on the leading edge of the technology with it. And one of the biggest things that would be a really good advantage to us is we want our products to be incorporated into everyday life, so that these cameras and UAV drones can be used in the house or used around, being as adaptable as possible. So here we have our performance targets for years 15 and 16. We'd like our earnings per share to be at $20 or starting with 15. We'd like our earnings per share to be $20. Our return on equity being 50% or higher. We've had a pretty high return on equity, which is well above what has been expected. So we want to at least maintain that and keep that going. Our credit rating, get an A-, and have our image rating be at least an 84. In year 16, we would like for our earnings per share to be 22. Return on equity, keep that same high rating as we've had, 50 or higher. Our credit image, have that at an A+, and our image rating being at 85. So here we do have our competitive strategy between our AC cameras and our UAV drones. So a little bit of backstory into this. We planned for our competitive strategy in the beginning to keep everything at a steady rate and make every year have a better camera for the consumer to use. Something that we found out later on was that that's not really the best approach for doing this. It made really good profits and made, from a profit standpoint, a really good ideal. But from a customer satisfaction standpoint, that was kind of decreasing. I know specifically for me, I don't like it. I don't like the whole Apple standpoint, if you will, where you got a new product every year and then your product feels like it's outdated after every year. That's something we were trying to avoid. And that's where actually that dip between 11, 12, 13, we were trying to correct that and change that. And that's where that dip came in at. So yes, and the next part is, this is where we changed to the price to performance strategy. And we'd like to release the next generation every 2 years or so that our customers don't feel left behind year after year. We have some more continued. Overall, our markets have been doing very well in North America, Europe, and Africa. We've been keeping about a 40% to 50% profit margin in those areas. Asia Pacific market has been doing well as well, with about 30 to 40%. And this is with both the cameras and UAV drones. The part we are lacking probably the most in is Latin America. And this is somewhere we have a huge improvement to grow. Over there, we have a 5% to 15% profit margin. So that's something we look to be coming to do in the next few years.
So our production strategy for our wearable cameras was we didn't require any workplace expansions or overtime hours to fill any of our orders. We grew as a company and had higher sales volume due to our amazing employees. For our wearable camera employees, we had an average employee compensation of about 35,000. UAV drones was a little bit higher, it's about 40,000. It was the same thing. We didn't require any expansions or overtime hours for that as well. So our financial strategy was, number one, we wanted to keep our dividends low to retain as much capital as we could for our company. We tried to keep our credit rating high by not overspending on things while limiting our liabilities. And we did very little stock issues throughout the 9 years we were doing this. And we had a debt to equity ratio of 38 to 62. So this shows that we have more equity in our company compared to our debt. So our main competitor throughout the course of this was Team A. Team A had a commanding lead throughout the semester. We really tried to stay with them, but it was very hard. They maintained a very high stock price, image rating, and credit rating. So they were doing very well. And we tried what we could to stay with them, but obviously we didn't make it. So how we plan to correct this was for our drones, we plan to outcompete them by offering longer battery times, larger range, and having the largest drones. And for our cameras, we wanted to outcompete them by constantly investing in R&D to have the most advanced models on the market. Also, from an employee standpoint, we wanted to offer the best compensation for our employees in both the UAV and the wearable cameras. And overall, the lessons that we learned were throughout the years, we saw that if we constantly kept releasing newer products, it wasn't the best strategy. It looked good from a profit standpoint, but not so good from a customer satisfaction standpoint. And we found that treating our employees well, both compensation-wise and ethically, resulted in higher morale and lower turnover overall.